Question 1. A trader who owns shares of a stock currently trading at $100 per share places a GTC stop $90 limit, $85 sell order. Assuming the specified stop condition is satisfied and the order becomes executed, which of the following statements is most accurate? A. The trader faces a maximum realized loss of $15. B. The order becomes a market order when the price falls below $85 and remains valid for execution. C. The order will be executed at either $90 or $85. The order becomes valid when the price falls to or below $90. The limit $85 sell indicates that the trader is unwilling to sell below $85. Thus, the trader faces a maximum loss of $15. The answer is A. Question 2. A Japanese exporter will sell US dollars for Japanese yen in the quote-driven currency markets. Which of the following statements best describes her currency exchange transactions? A. Her counterparties are dealers. B. This currency exchange transaction takes place in organized exchanges. C. She will pay commissions for exchange services. In the quote-driven currency markets, dealers are counterparties to currency exchange transactions. The answer is A. Question 3. A market index contains the following two securities, Stock A and Stock B. The total return on an equal weighted basis is closest to The shares in index for Stock A is 600. The start of period price for A is $40. The end of period price for A is $37. The dividend per share for Stock A is $2. Therefore, the price return is 37 divided by 40 minus 1 equals negative 7.5%. total return is 37 plus 2 divided by 40 minus 1 equals negative 2.5%. The shares in index for stock B is 500. The start-up period price for stock B is $50. The end of period price for B is $52. And the dividend per share for stock B is 1.5. Applying the same techniques, we can get the price return for stock B is 4%, and the total return for stock B is 7%. Therefore, total return equals negative 2.5% plus 7% divided by 2, and we get 2.25%. The answer is C. Question 4. The advantages to an investor owning convertible preference shares of a company most likely include A. An opportunity to receive additional dividends if the company's profits exceed a pre-specified level. B. Preference dividends that are fixed contractual obligations of the company. C. Less price volatility than the underlying common shares. Convertible preference shares tend to exhibit less price volatility than the underlying common shares because the dividend payments are known and more stable. The answer is C. Question 5. The index weighting that results in portfolio weights shifting away from securities that have increased in relative value toward securities that have fallen in relative value whenever the portfolio is rebalanced is most accurately described as A. Float-adjusted market capitalization weighting, B. Equal weighting, C. Fundamental weighting. Fundamentally weighted indices generally will have a contrarian effect in that the portfolio weights will shift away from securities that have increased in relative value and towards securities that have fallen in relative value whenever the portfolio is rebalanced. The answer is C. Question 6. An industry experiencing slow growth, high prices, and volumes insufficient to achieve economies of scale is most likely in the A. Shakeout stage, B. Mature stage, C. Embryonic stage. An embryonic industry is one that is just beginning to develop and is characterized by slow growth, high prices, volumes not yet sufficient to achieve meaningful economies of scale, developing distribution channels, and low brand loyalty because there is low customer awareness of the industry's product. The answer is C. Question 7. Which of the following financial intermediaries is most likely to provide liquidity service to its clients? A. Dealers. B. Brokers. C. Exchanges. The service that dealers provide is liquidity. Liquidity is the ability to buy or sell with low transaction costs when investors want to trade. By allowing their clients to trade when they want to trade, dealers provide liquidity to them. The answer is A. Question 8. The behavioral bias in which investors tend to avoid realizing losses but rather seek to realize gains is best described as A. The gambler's fallacy. B. The disposition effect. C. Mental accounting. Behavioral biases in which investors tend to avoid realizing losses but rather seek to realize gains is the disposition effect. The answer is B. Question 9. An investor buys a stock on margin and holds the position for 1 year. Assuming that the interest on the loan and the dividend are both paid at the end of the year, the price at which the investor sold the stock is closest to total purchase value equals purchase price times shares purchased. And then we minus initial equity. Amount borrowed equals total purchase value minus initial equity. Margin interest paid equals call money rate times amount borrowed. Dividend income equals dividend per share times shares purchased. Gain from price appreciation equals total return minus dividend plus margin interest. Price at which investors sold the stock equals gain from price appreciation per share plus purchase price. The answer is B. Question 10. Which of the following statements concerning the objectives of market regulations is least accurate? Regulators A. Set standards to ensure that all agents acting in the market are skilled. B. Ensure systems are in place to prevent fraud. C. Promote fair and orderly markets. Regulators help solve agency problems by setting minimum standards of competence, not skill, for agents and by defining and enforcing minimum standards of practice. The answer is A. Question 11. An observation that stocks with above average price to earnings ratios have consistently underperformed those with below average price to earnings ratios least likely contradicts which form of market efficiency? A. Weak form. B. Semi-strong form. C. Strong form. The observation that stocks with high above average price to earnings ratios have consistently underperformed those with below average price to earnings ratios is a cross-sectional anomaly. It's a contradiction to the semi-strong form of market efficiency and the strong form market efficiency because all the information used to categorize stocks by their price-to-earnings ratios is publicly available. It's not a contradiction to weak form market efficiency. The answer is A. Question 12. Which of the following statements concerning financial regulatory bodies is least accurate? Financial regulatory bodies A. Act to level the playing field for market participants. B. Define minimum standards of competence for agents. C. Require that regulated firms maintain optimum levels of capital. Financial regulators impose minimum levels of capital that apply across the board to all regulated firms, not the optimum level, which is firm-specific. The answer is C.